Welcome to the dynamic world of self-employment. Many individuals choose this path for its unparalleled freedom and flexibility. You become your own boss, setting your own hours and charting your own professional course. However, this autonomy comes with a unique set of responsibilities, particularly concerning your tax obligations. Among these, understanding and managing self-employment tax is absolutely paramount. This tax is a significant financial consideration for freelancers, independent contractors, and small business owners. Failing to grasp its intricacies can lead to unexpected financial burdens and potential issues with tax authorities. Understanding self-employment tax is incredibly crucial as we navigate the economic landscape of 2025. This tax directly impacts your net income and, consequently, your overall financial planning. Proper management of self-employment tax helps in avoiding unwelcome surprises, such as hefty tax bills or penalties for underpayment. More importantly, it ensures your long-term financial health by fulfilling your obligations towards vital social insurance programs. This essay aims to provide a comprehensive overview of self-employment tax in 2025. We will begin by demystifying what this tax entails, breaking down its core components. Self-employment tax is a term that often causes confusion, but it's essential to understand its true nature. It is not an additional, punitive tax levied solely on those who work for themselves. Instead, it represents the way self-employed individuals contribute to Social Security and Medicare programs. If you were a traditional W-2 employee, your employer would withhold these taxes, often referred to as FICA taxes, from your paycheck, paying half, 7.65%, as the employer's share, and withholding the other half from your wages as the employee's share. As a self-employed person, you are considered both the employee and the employer. Consequently, you are responsible for paying both portions, which totals 15.3% on your eligible net self-employment earnings. Let's delve deeper into the Social Security component of the self-employment tax, often referred to as OASDI. Old age, survivors, and disability insurance. For 2025, this portion accounts for 12.4% of the total 15.3% rate. The primary purpose of Social Security is to provide a safety net and income source for individuals during retirement. For the tax year 2025, the combined self-employment tax rate remains at 15.3%. It is crucial for every self-employed individual to internalize this figure, as it forms the basis for calculating a significant portion of their tax liability. The larger portion, 12.4%, is allocated to Social Security, old age, survivors, and disability insurance. The remaining 2.9% is designated for Medicare, hospital insurance. A critical aspect of the Social Security component of self-employment tax is the annual wage base limit. For the tax year 2025, the Social Security Administration has set this limit at $176,100 of net self-employment earnings. This means that the 12.4% Social Security tax is only applied to your net self-employment earnings up to this specific threshold. In contrast to the Social Security portion, the Medicare component of the self-employment tax does not have an income ceiling for its base rate. The 2.9% Medicare tax applies to all of your net self-employment earnings, regardless of how high they might be. Calculating your actual self-employment tax liability involves a few steps. First, you determine your gross earnings from all self-employment activities. From this, you subtract all ordinary and necessary business expenses to arrive at your net earnings from self-employment. Then, you multiply these net earnings by 92.35% to find the taxable base for self-employment tax. Structuring your business as an S corporation, S Corp, can significantly reduce self-employment tax. An S Corp allows profits to pass through to owners' personal income without corporate tax. Unlike sole proprietorships or LLCs, S Corp offer a unique tax advantage. Owner employees must pay themselves a reasonable salary, subject to employment taxes. Remaining profits can be distributed as dividends, not subject to self-employment tax. This split can significantly lower overall tax liability. However, S Corp status involves more administrative overhead. Section 5. Maximizing deductions. Lowering your net earnings from self-employment. Lower net earnings from self-employment mean lower self-employment tax. Deduct all legitimate business expenses to reduce your net earnings. Track expenses diligently. Common deductions include home office expenses, utilities, marketing, travel, and professional fees. Deduct premiums for medical insurance and half of your self-employment tax liability. Meticulous record keeping is essential for maximizing deductions. Section 6. Retirement savings, a powerful tool for SE tax reduction. Contributing to retirement plans like SEP IRA or Solo 401k offers tax advantages for self-employed individuals. These contributions can be deducted from your gross income, lowering your net earnings and self-employment tax. Retirement planning becomes a strategy for current year tax savings. Section 7. Understanding the Qualified Business Income (QBI) deduction. The Qualified Business Income (QBI) deduction, often referred to as Section 199A, is a significant tax provision that can benefit many self-employed individuals and small business owners. It was introduced as part of the Tax Cuts and Jobs Act of 2017. It's important to clarify at the outset that the QBI deduction does not directly reduce your self-employment tax. Self-employment tax is calculated based on your net earnings from self-employment. The QBI deduction, however, is taken after your adjusted gross income (AGI) is calculated, thereby reducing your overall taxable income for income tax purposes. While it doesn't lower your SE tax bill itself, the substantial reduction in your income tax liability can free up significant cash flow, indirectly easing the overall tax burden. So how does the QBI deduction work? Generally, it allows eligible taxpayers to deduct up to 20% of their qualified business income from a qualified trade or business. Qualified business income typically includes the net profit from a sole proprietorship, partnership, S corporation, or LLC that is treated as a pass-through entity for tax purposes. It does not include items like W-2 wages, capital gains and losses, dividends, or interest income. The deduction can be quite substantial, potentially shielding a significant portion of your business income from federal income tax. However, the QBI deduction comes with certain limitations and thresholds that can make its calculation complex. Section 8. Advanced Strategies and Common Pitfalls, Navigating with Care. Beyond the foundational strategies, some self-employed individuals might consider more nuanced approaches to manage their tax liabilities, but these often require careful planning and an understanding of potential pitfalls. One such tactic involves income timing. If your income fluctuates or you anticipate being close to certain tax thresholds, such as the Social Security wage base, $176,100 for 2025, or the income levels for the additional Medicare tax, you might consider legally deferring some income into the next tax year. This could involve delaying invoicing for work completed late in the year until January. However, this must be done legitimately and within the bounds of constructive receipt rules. You cannot simply choose not to cash a check you've already received. Correct income classification is another area that demands extreme diligence. All income from your trade or business activities should generally be reported on Schedule C, Form 1040, making it subject to self-employment tax. Attempting to misclassify business income as other income to avoid SE tax is a serious compliance risk. Claiming business losses can also impact your self-employment tax liability, as legitimate losses can offset other income. However, the IRS has stringent rules regarding business losses. For instance, you must be able to demonstrate a profit motive, and the hobby loss rules prevent taxpayers from deducting losses from activities not engaged in for profit. Section 9. Why expert guidance matters. Consulting a tax professional in 2025. Navigating self-employment tax can be complex. The intricacies of S corporation rules, deductible expenses, and retirement plan contributions demand attention. Tax laws change frequently. A qualified tax professional is indispensable. They ensure compliance, identify deductions, and offer strategic advice. In conclusion, expert guidance is crucial for tax efficiency.